us. We want to bring in Martin Feldstein, former economic advisor to George W. Bush's presidential campaign, along with Savita Subramanian. She is head of U.S. equity and quantitative strategy at Bank of America Merrill Lynch Global Research. Good to see you both. Thank you so much for joining us. Marty, what's your take on the Fed's decision?
Well, I had wished that they had moved, that they had increased it, but I didn't expect them to do so. I think their hope is to keep driving down the unemployment rate under 4% in order to boost real wages and to bring some of those people who are now peripherally semi-attached to the labor force back into work.
It's interesting that you choose 4%. The red line keeps moving down. The Federal Reserve did have a line of about 6%, right?
Well, no, they said at 6 they wouldn't increase. But, I mean, their line for full employment was 5.1. Now we're there. And
you're kind of worth 4%.
I interviewed a lot of people over the last couple of days, professional investors, traders. They all sound like you. I wanted them to raise rates, but I don't think they will. Now, why do you want them to raise rates? It's a logic here that is missing from the Federal Reserve.
So the reason I want them to raise rates is that these very low rates that we've now had for years have led to risky behavior on the part of investors.
Saying.
And we don't know how much damage that could do.
Right.
But they've got to normalize. They've got to get back. They've got to take away the incentive for investors to overprice commercial real estate, overprice equities, take
Alibaba.
high risks. Yes, take high risks with.
Great point.
So that's really the reason why they should be doing it, and they have to do it sometime soon.
I've got to push back. I'm going to push back in a minute because I want to look at some of the data points of this economy. Because if it's such a slam dunk, I want to know why 9 Fed officials said we can't raise rates right now, and only one, Flacker, said that rates should be higher. Savita Subramanian, Bank of America Merrill Lynch, what did your desk look like, your trading desk, when this news first came down? And give us your observations on this lack of move, Savita.
Well, a surprising lack of volatility today. But, it was interesting. So this is supposed to be one of the most transparent Fed administrations, and yet we were heading into the hour not knowing how things were going to go, split, pretty much down the middle in terms of whether we saw a hike today or not. I also wish the Fed had gone ahead and got us off of a zero bound. The economy is not great, but it's not an emergency zone, and we can actually get ourselves off of that sort of emergency level zero bound. We think the Fed's going to go sometime this year. And, what is a little bit troubling is that the data set that the Fed pays attention to is now includes emerging markets. We saw a little volatility around that earlier this summer, and I think that that's going to take the lens of the Fed. It's no longer just about the U.S., but it's about how EM's softness could actually spill over and affect U.S. growth.
And
so
that's what she said.
Big takeaway.
Yeah, that's what she said.
Exactly.
She said the global developments are likely to put downward pressure on inflation, and because of recent developments in the global economy, we're leaving rates unchanged. Your comments there, Marty Feldstein.
But I think while those are reasons to give, I think the real reason is about the domestic economy, a desire to drive down unemployment a little further, a desire to push up real wages. Everybody remembers Alan Greenspan reaching further than most market participants and most economists thought was safe, and he sure turned out to be right, and she'd like to do that.
But I'm scratching my head how this does that. I mean, how does no move in interest rates move wages when, in fact, we've been at zero now for 7 years and wages haven't done squat?
Because listen to Mark. I'm sorry, go ahead.
Well, I was going to say, we're getting to a point where the unemployment rate is very low. What she said was, history tells us that as as labor markets tighten, there are going to be increases in wages, in real wages.
If you listen to people like Mark Zandi, that's what he's saying. It's coming. It's going to come. And why slow up the process? I look at it differently. I look at it that, it may come, it may not come. I don't think 25 basis points slows it, but 25 basis points says something about risk taking. Maybe it's better to keep your money in the bank than buying Alibaba or something like that, or something along those lines.
And I think about it as the opposite, because with zero interest rates, I'm not making any money in the bank.
Well, that's what I'm saying. Yeah, that's why you raise it.
Yeah, that's why you raise it. Absolutely. Savita, what does the world look like now in the next couple of months? How does this impact things? Give us your, real practical impact here.
So I think it's really more of the same. We're sort of stuck in purgatory for, another month.
More uncertainty.
And, what's that?
More uncertainty.
Yes, exactly. So uncertainty is the name of the game. I mean, it's not like we were going to get past today, and if the Fed had hiked, the clouds would lift and the world would be clear, but at least we would have seen what it felt like to get off of a zero bound. We can't say that we've gotten past that yet. So I think we're going to see more of the same, more volatility. How do you invest in this market?
Yeah,
I think high quality is where you want to be. The only tried and true relationship we've found is that high quality stocks outperform during turbulent, volatile times.
So you're telling clients to buy high quality stocks on this move or not move?
That's right.
Yeah.
Yeah. Well, it's less.
On this
safer.
lack of a move, on this lack of clarity that we're getting today.
Charlie,
I want to ask kind of a dumb question, at least for me, and maybe a lot of viewers think about this. How does the Fed actually come up with this interest rate decision? This FOMC comes up with it, right?
Yes.
And then the board approves it?
No, it's the FOMC.
So a 9-1 is pretty unanimous, correct?
that's what I was trying to say earlier,
that's part
Charlie.
of the culture.
And Mark said, no. But
that's part of the culture of the FOMC. I mean, there are several members of the FOMC who would like to see an increase, and they've been there in the past. But in general, they get this. They have the sense that, look, I've been listened to. We've made our arguments, and we're not going to vote against the chairman.
Mm-hmm. The chairman noted the participation rate. Here's my pushback for you, because you said the economy is doing well. 38% of working Americans are out of a job, and they don't care. They're not even looking for a job. That's the labor participation. Yeah,
not of working Americans, of working age.
Working age Americans, right? Working age Americans. They don't have a job, and they don't even want to look for a job.
Right. Okay.
So when you look at the participation rate, so that's a negative, and that's something that she considered.
Yes, but they know, the Fed knows why the participation rate has come down. It's come down about 3 percentage points. About half of that is because of the aging of the population. Because as more people move into their 60s and 70s, the retirement rate goes up. Part of it is due to changing behavior of young people, young women with children. So what's left is a very small amount, less than 1% of the decline.
So you're saying the U6 number is more positive than what we've been given? We've been using that as a rationale for hating Barack Obama's economic policies now for years.
No. I think the economy, the labor market is in very strong shape. The unemployment rate among college graduates is 2.5%.
Right. Yes. You're right about that. Yeah, absolutely.
We're in full employment. And, of course, productivity growth has been super, super low. So if productivity growth is low, it's not surprising that wages aren't moving. So part of the story about why we're not seeing increasing wages is that the usual driver, increases in productivity, just aren't there.